Over the years, I've worked with hundreds of people who found themselves trapped in bad investment products that essentially force them to stay invested or face massive penalties to transfer out. I recently spoke with someone who would have had to pay $100,000 in taxes just to sell or transfer out of their current investments. And so, they either had to choose to stay in a bad, expensive product or pay the tax and move on. And so in this video, I'll break down what these types of investment products are, the risks of investing in them, and how you can protect yourself moving forward. And to help me out, I'm bringing in John Kootenay from our planning team. All right, John, thanks so much for joining us today. So I'll let you jump into it. Like, what are these investment products that I'm talking about, these proprietary investment products? Maybe explain this to the audience.
So a proprietary fund is generally an investment that's held by a firm. Basically, if you're going to see the firm's name at the front of the investment, that could be a proprietary fund. So they internally manage the stock picking, bond picking, and any alternative pools that they might have. And what we're seeing more prevalent in the industry now is sometimes if you try and transfer these out, they don't allow them to transfer in kind. So we wanted to make a video about this.
An in-kind transfer means that if you're moving from ABC Co to XYZ Co, in kind would be, look, I want to keep my investments the same. I just want to move them from kind of place A to place B and not sell anything. Of course, if they're proprietary, to get them from place A to place B, you actually have to liquidate them. And so, yeah, if you walk into a firm and it's, ABC co-investment firm, and the product they're selling you is also ABC Investment Co, balance fund, it may be proprietary to them and it may not be able to transfer out, which we bumped into here the last little bit, especially. But again, we both, for decades now, we bumped into this with these proprietary funds that are creating a bit of a headache for clients. So a recent example we came across is a client transferring out to CIBC. And again, CIBC has these proprietary funds in this one client account. Now, proprietary funds aren't everywhere for everyone. Like typically, if you walk into your bank and you have under $500,000 in mutual funds, typically those mutual funds aren't necessarily proprietary. But John, like where would a client typically see proprietary funds?
So you generally see them in the wealth management space. So if you have, anywhere over 500,000, maybe over $1 million, you might be into what's called a discretionary model. So a discretionary investment model. And that's where the portfolio manager can actually make stock picks on your behalf without calling you for every single trade. This allows for easy access to enter the market at good time or exit the market at good timing without having to call every single client in their portfolio. So they can really effectively manage a book much better with the overall portfolio structure and strategy. But as we're seeing in the industry now, if people want to make a move for whatever reason, like years down the road, it can cause a little bit of issues with respect to capital gains. You're going to trigger a taxable event if you have to transfer in cash. And so that can sometimes be a consideration when you look to start a relationship over a very long period of time with your investment.
And really only affects, in that case, non-registered accounts. Like if you have to transfer an RSP or any registered account in cash, that's fine. That it doesn't trigger kind of a tax disposition. But let's say you've built up a non-registered account over many years and you've had a lot of gains, like it's done well and you have 100,000 plus gain. If you have to sell that investment to move to an alternative option, that's probably not a great idea. And you ran across this recently online, correct?
Yeah. I saw a great post on LinkedIn about a client who was, I think, 30 years with a firm, and now they were kind of trapped into a $1.2 million capital gain, which generally in our planning, we would want to liquidate that over time. But if the client is feeling like they want to move for whatever reason, advisor or just location, for example, to trigger a $1.2 million capital gain in one single calendar year, not often you're going to see that in a financial plan.
Yeah, crazy. And we have that right now, not that big of a number, but we have a client transferring over to one of the investment firms we work with, and we're doing the ongoing planning with them. And yeah, they have a big non-registered account in a proprietary fund that we want to liquidate, and there is some gain there. So it's kind of, now we have to put this into the plan, which is fine. But again, the client's not getting what they want, which is, hey, this isn't working for me anymore. I want to go over here and I want better structure and planning, investments, etc. But now they're kind of hand tied, and it's probably going to take a few years to slowly liquidate that over time. We have another client actually right now that we just brought on that everything will be transferred out, but there's actually a proprietary fund in their RRSP. So not in a non-registered account, but an RSP, where proprietary in nature in that they can't sell it for X amount of years. Like, so it's a private real estate deal. And as I was doing the due diligence for them, figuring out like, hey, what is this? How is it structured? Can we get it out? Sure enough, like originally when this real estate deal was put together, there was one big investment firm here in Canada that had full exclusive rights to sell it. So basically they go to this investment firm and says, hey, just get this out to your clients. We need assets. And now the client's stuck in that. A, investment hasn't done well. And B, there's that amount. It's going to be stuck at their old planning firm until it kind of frees up. So again, proprietary funds can create a lot of issue and potentially cost you a lot of money. And we'll get later in this video, we'll talk about how to look out for it and how to avoid it. Make sure you don't fall into this trap.
Yeah, it's important to be educated and ask the questions up front before you sign a commitment. I've seen lots of like private issues, for example, where you do have a lockup period, and it's very transparent. Like it's well known, you have to sign a document to get into the investment. Generally, they'll come with a pretty large minimum investment, not like $1 million, but probably close to 100,000, for example. But with that, sometimes you do have that lockup period. You can't liquidate for 10 years because they need that capital to structure the deal. So they're not bad, but it's important to know the risks. Same as investing in a GIC. If you need liquidity to buy a house or, spend money on a car, you might not want to lock in your money for 5 years and have have a penalty to get out, right?
I'd like to thank the sponsor of today's video, Harvest ETFs. Looking to invest in the financial backbone of the US economy? The Harvest US Bank Leaders Income ETF, HUBL, is your gateway to the most dominant banks and financial institutions in the country, delivering steady income and long-term growth potential. HUBL provides a diversified portfolio of large cap US banks and financial stocks. Consistent monthly income, making it a smart choice for income-focused investors, and the potential for capital appreciation as these financial giants grow over time. With a focus on core dividend-paying financial stocks, HUBL is built for investors who want reliable cash flow and exposure to a key sector of the economy. Plus, its active management strategy helps enhance income and reduce volatility. HUBL is available in 2 currency classes, hedged and US dollar, giving you the flexibility to invest in the way that works best for you. Whether you're looking to boost your monthly income or position your portfolio for long-term growth, the Harvest US Bank Leaders Income ETF provides a strong, stable, and strategic way to invest in US financials. To learn more, click the link below. So I want to go through 4 major risks you need to know about around proprietary funds. So 4 things. So John, number 1?
Number 1 would just be liquidity. Like, are you able to get out? Can you transfer out in kind? If you had a do-it-yourself investment account and you hold XYZ stock and you move it to a different institution, you can do that without triggering a capital gain. And this is especially important for non-registered investment accounts, also known as cash or margin accounts. And then also corporate accounts can't be overlooked because those will attract capital gains. So I'd say that is very important.
Yeah, and I feel like you and I have been in this business a couple decades now coming up, and like we used to see DSC funds, like DSC funds, deferred sales charge, where is a mutual fund that if you sold it in the first 7 years, you would pay a fee to get out of that fund. Those have kind of gone away. Almost always see the odd one come through still for
They're
somehow,
rare
but
for sure.
very rare. But now we're seeing more of these like proprietary funds. It's kind of the next way to like lock your client in and keep them with you and hold the asset. And all firms do it. All big banks, financial institutions, they all have it. And typically, again, like it's actually the higher net worth clients that have these types of investments. And higher net worth clients typically have non-registered accounts. So that's why it's really important to really understand what we're talking about here. So the second major risk is high and hidden fees. So a lot of times I'll take this client that we have that did the private real estate deal. Again, the upfront commission would have been, 3, 4, 5+% to the advisor. So there's an incentive for them to sell that versus something else. There could be an ongoing high fee built into it as well. So oftentimes these proprietary investments will have a higher fee and often hidden, right? It's like, oh yeah, we have this real estate deal, you're locked in for 5 years, but we're targeting 12, 15, 20%. Well, there's probably a 3 to 5% fee also built into that. Now, if you're getting 15%, you may not care about a 3 to 5% fee. I get that. But what happens if real estate turns like it has? Like a lot of real estate deals in Vancouver, in Toronto, are at a negative right now. They're not making money, and you're still paying that fee. So you're going to have a net loss potentially on some of these deals. So just be aware of what the actual true cost is, and ask your advisor, like, what's your upfront commission on this? Because typically, not always, but a lot of times they're collecting a nice paycheck on that.
Yeah, and that can incentivize. I mean, it comes to a bit of a conflict of interest, but certainly firms can push product and things like this. I don't think that's that's not a secret in the industry.
So number three, major risk.
I'd say like limited investment choices. So sometimes if you're in a pooled structure, you might want to hold an overweighted position in a specific stock because you've got an emotional tie to it, which we'll save that for a different YouTube video. Yeah. But mainly it would be because you worked for a company for a number of years and they have an employee share ownership program, right? So you might be over concentrated in a single position. If you're in that pooled structure, you might not be able to hold those funds. In addition to that, like if you wanted to hold an ETF, for example, because it's low cost and good access to the index, then if you're in that pooled structure, you might not be able to hold like individual securities that you want to get access to.
Yeah, and the fourth major risk, I seen you touched on it earlier, is just a conflict of interest. Like, are you being, say, sold that investment because it's the right option for you, or because it's the right option for your advisor? And what is that conflict of interest? Again, when I did the due diligence for this one client, just again this past week, we've seen the internal memos, right? Friends, I've never worked in the banking sector, but there's memos that go and say, hey, we need to get, $10 million into this fund or this, private placement. And, if you can get $1 million in, you get a trip to Vegas or whatever. Like there's these bonus scenes that happen in the background that aren't disclosed. So is there a conflict of interest, or is it really the best? Now, again, there's some great investments out there that are great for you as a client, but there's this other bucket. We're talking about the other bucket, right? So again, transparency, have those hard conversations with your advisor. Make sure you understand what you're getting into. We see it again and again. And again, your advisor might be good. I talked about in a few videos ago in that, your advisor for the last 30 years could have been great for you, made money, the accumulation phase. And then you hit this decumulation phase. And we see a lot of clients change advisors, change investment structure, strategy, all of that. So yeah, your life changes as you hit retirement. And so that change shouldn't cost you because of an investment your old advisor put you into. Like, you should have that flexibility within your plan and your investment portfolio.
Yeah, flexibility and ease of access to funds, especially as you approach a decumulation stage. And a lot of our clients are in that retirement stage. So we are looking to decumulate assets and manage the tax liability over time as you spend your money, as you should.
Exactly. So how to protect yourself. And this is, really important for all of you watching this video. It's like, okay, Adam, I understand this now, but like, how do I actually protect myself? So the first thing would be ask questions. Again, have the conversation. Like, you're paying your advisor for planning, for investments, for whatever they're doing for you, but you're paying them. Ask the question if they're recommending a product to you that you're not fully aware of or don't understand the ins and outs. Like, ask the tough question. What are the fees? What's the structure? Am I locked in? If I ever decide to, bring my investments across the street, can I bring this product or not? Like, and then get it in writing, right? Something verbal isn't going to stick. Record it or get it in writing. So that's what I would say there. Look for transparency. So again, are restrictions clearly disclosed? Like, hey, you're locked into this for 7 years. A lot of people have no idea. So again, be aware of if you get anything outside of the normal investment, what are you locked into, right? And again, be aware of the firm you're working with and the name of the investment. Like any of the big, like RBC, you walk into RBC, buy mutual funds, they're going to sell you RBC mutual funds. TD, all the big banks, all the big financial institutions do it. And that's not necessarily what this video is about. It's once you get to a bit of a higher net worth or alternative products, are they selling you something that you can't bring elsewhere if elsewhere is better for you? And so just have that conversation. Like if the name on the door matches the name of the investment, there could be an issue there. So again, have that open conversation. But again, like you said earlier, John, it's actually typically at more of a discretionary level. Even within the banks, even like at this higher net worth, the Raymond James of the world, that kind of stuff. All the firms do it, but just be aware of what you're getting into. So I think the biggest takeaway for all of you viewers would be review your current portfolio. is there anything in there that's like, oh, I don't really know what this is, right? It's not a stock, it's not a mutual fund, it's not an ETF. It's this other thing. What is this? Have that conversation with your advisor. Like, is this something that I'm locked into? What fees am I paying? Like, can I transfer it elsewhere? These are things a lot of you just put aside. Trust your advisor, which is great. You should build that trust. But if you see that red flag, have the conversation.
And what are the underlying holdings of XYZ equity fund, for example, right?
Exactly. Yeah. No, for sure. And like I said, the most recent one we had come through was CIBC. And it was these, and I never come across it with CIBC before, but they're CIBC funds that were proprietary. So it wasn't like a basic CIBC mutual fund, which typically these were like their own in-house product. And so it can be quite convoluted. And this is where you need to ask the questions of like, are these a flexible product, and are they best for me, or are they best for you, the advisor?
Yeah, that best question probably is, am I able to transfer this out in kind if I choose to move to a different institution?
Exactly. That's really kind of,
then you're probably in a proprietary fund.
Absolutely. No, and that's a great way to ask it and to kind of structure it with your advisor. Because again, a lot of us don't know how to say it. We don't want to say it. We're scared to ask the question. Just send an email to your advisor like, hey, am I able to transfer these out in kind if I ever wanted to? And
if the answer is, I'm doing it, I just want
to know exactly. Yeah, I still love you, option. But exactly. So, So anyway, we wanted to create this video on the proprietary products, because we've seen it for many years, but we've seen it more come through the office lately. Conversations with clients, and again, as you reach retirement and walk into retirement, cash flow is king. So as you get a good plan in place, the cash flow you're producing out of your portfolio matters. So if you're locked into a product, if you don't have that flexibility, you may not have that flexibility in retirement that you actually need and are looking for. So it's not just like transferring money, it's also living retirement, drawing money out. So just be aware of what you hold, especially as you ramp up for retirement, so that you put yourself in the best position to enter retirement and draw out the cash flow in the most tax efficient manner moving forward. So John, thank you so much for joining us in this video. Really appreciate it. And we'll get you back on here really soon.
Thanks so much, Adam. Appreciate it.
Yeah.